Hello everyone, it's Friday, July 4. Today we're taking a closer look at the euro and British pound charts to assess potential market movements. Both the euro and the pound sterling gained upside momentum in early trade yesterday, supported by upbeat data on services activity in the Eurozone and the UK. The Eurozone Services PMI came in at 55.5, well above the consensus estimate of 50, signaling robust expansion and underscoring positive trends in European economic development. This improvement contributed to a rise in the composite PMI to 50.6, pushing it back above the 50-point threshold that separates growth from contraction. UK data was similarly encouraging, particularly given that the services sector accounts for about 80% of total economic output. The UK services PMI rose to 52.8, limiting the downside potential for the pound-dollar pair in the first half of the trading day and supporting its recovery. The composite PMI also held above the 50 mark at 52.0. Later in the day, traders turned their attention to U.S. labor market figures. Non-farm payrolls increased by 147,000 in June, surpassing economists' expectations of a 120,000 gain. This was a solid result, especially considering that the ADP report had indicated a decline of 33,000. In addition, the U.S. unemployment rate fell to 4.1% in June, down from 4.2% the previous month and better than the forecast of 4.3%. Investors initially welcomed the data as a positive signal for the U.S. economy. However, this optimism later faded. A resilient labor market allows the Federal Reserve to maintain its wait-and-see approach, keeping interest rates elevated in anticipation of potential inflation pressure risk driven by President Trump's tariff policies. While the strong jobs reported briefly helped the dollar recover, the bullish momentum quickly ran out of steam. It is clear that much now hinges on Trump's next moves regarding trade tariffs. Today, the White House is expected to begin sending formal notices to trade partners that have yet to reach agreements with the U.S. So far, tariff negotiations have produced only 3 deals, with the United Kingdom, China and Vietnam. No agreements have been reached with the Eurozone or other major trading partners. We'll see how markets react as the July 9 deadline approaches. What is more, President Trump is set to sign his One Big Beautiful Bill into law today. It is a sweeping tax and spending card package expected to add trillions of dollars to federal deficits. After the signing, demand for risky assets could rise, putting renewed pressure on the greenback amid skepticism that the bill will deliver meaningful economic benefits to the U.S. Now let's take a look at today's macroeconomic calendar. The United States is closed for the Independence Day holiday, so trading activity will largely center on the European session. The calendar includes data releases on German factory orders, French industrial production, and Italian retail sales. The Eurozone will publish producer price figures for May, although this report is unlikely to spark significant market moves. In the UK, investors will be watching the release of construction PMI data. In addition, British investor Martin Taylor is scheduled to deliver a speech. However, the market has shown little reaction to his recent comments, so his remarks may have limited impact. Overall, if UK construction data surprises to the upside, it could help the British pound extend its bullish momentum. With no major U.S. reports scheduled today to weigh on risk assets, sentiment may remain relatively constructive during European trading hours. From a technical point of view, the 1-hour EUR USD chart shows that a false breakout at 1787 or 1.1825 would generate a sell signal, with the euro potentially sliding to 1749 and even 1713. In the event of a steep rise in the euro, it would be wise to go short on the rebound at 1866, targeting a 35.40p move. If the price breaks through 1749 and fixes below this level, the euro could dip to 1713 and extend its weakness further towards 1676. At this mark, I would recommend going long on a rebound in anticipation of an intraday correction of 25-30 pips. Long positions at 1713 and 1749 should only be considered after a false breakout, as one cannot rule out of the pair getting stuck in a wide sideways range. As for the British pound, bulls need to push the price up to 36.72. Consolidation above this level will help them recoup earlier losses and pave the way for further gains toward 37.07, with the most distant target at 1.3746. At this mark, traders are advised to go short on the rebound, targeting a 35.40 pip move. Short positions at 37.07 and 36.72 would be relevant of the false breakout, especially if UK construction data disappoints. In this scenario, sterling could drop to 1.3637, 1.3602, and even the 1-week low of 35.65, where I would recommend going long on the rebound to catch an intraday correction of 35.40 pips. Long positions at 36.37 and 36.02 should only be opened after a false breakout. Good luck to all and have a nice weekend.